Good morning, everybody. Welcome to the Flow Show. Hope you're doing fine and dandy this morning. Good morning, Kay. How you doing, mate?
Good morning, Ryan. Good morning, everybody. Yeah, I'm doing all right. I'm doing all right. Getting ready for Mr. Powell later today. I suppose that's going to be one of the events of the week.
Yep, it's sure looking like it at the moment, the way the dollar's reacting. Yeah, it's definitely, I think, going to be one, potentially the most important move of the week or item of the week. If he says anything, he could all leave us hanging by not mentioning anything. And as usual, we build it up into something that big that ends up being a bit of a dead duck. But yeah,
That's
I'm
our
going to be back at
that's
my
our
desk for that.
fate. That's our
Yep.
fate. Building up to the next biggest event ever. That's our fate.
Yeah, who'd be a trader? Right, well, let's get on with what we do know rather than what we don't know. What we do know is that China data is improving. We had quite a bit of data out overnight. GDP for Q1 coming in better than expected, 1.6 on the quarter, 5.3 on the year. Investments much improved as well. Retail sales improved, though not as much as expected. Industrial production up as well. Again, not as much as expected on a month. Not as much as expected on the year-on-year number, but better on the year-to-date number. So good numbers coming out from China at the moment. A lot of people are quite skeptical about Chinese data, but it is what it is, and the market's going to react to it one way or another or completely ignore it. China's Deputy Director of the National Bureau of Statistics said that China is to see inflation slowly rise. We got the last inflation print was a positive number versus a couple of negative numbers, though it was softer than expected. But they say it's going to slowly rise, which it should do if those economic data numbers continue, shows a bit of activity, which should bring some inflation with it. Over at, I'll go to Japan next. There's not been really much out from those guys. Usual jaw-boning waffle from Suzuki. I didn't see anything of that changes from those comments there. Still watching, waiting, looking on that front. ECB's Ren says key interest rates can be lowered in June if inflation slows as expected, but says rate cuts are data dependent. ECB's Casimir rates can be cut in June given the persistent fall in inflation, and that restriction can be gradually relaxed, though not committing to any policy path beyond June. Casimir is one of the hawks over there, so doesn't want to give the doves any leeway for July, it seems. It says we must maintain the flexibility of policy. The economic recovery is taking hold and will accelerate in the second half of the year. ECB's Lane, his big watch has been wages, and he says wage pressures are gradually moderating, though they're still elevated. ECB's McClough says a 25 pip cut in June is possible if the CPI trend persists. Over to data out of Europe, a few bits and bobs. We've got Italian CPI there, some German price data there. Prices on the month for this wholesale price index up 0.2% on the month, but still negative on the year. Italy, these were the final numbers for inflation, which came in a little bit softer than the flash data. Largely unchanged, a tiny bit softer on the Eurozone measure there. German zoo was out, and we got a bit of an improvement again in the economic sentiment, 42.9 versus 35.9 expected and 31.7 previously, though current conditions improved, but didn't improve as much as was expected. They were expected to improve to minus 76, came in at minus 79.2. So still in the doldrums, but a slight improvement there. Eurozone number, not really important, but that improved also. Over to the UK. Big numbers out, jobs numbers. Now a tale of two here, where employment was worse. We've seen the claimant count rising, but not as much as expected. But unemployment rate jumped to 4.2%, much higher than the 4% expected. Employment change down 156,000 on a 3-month rolling basis. But to counter that, sticky wages. Wages were expected to drop a bit. They came in unchanged. They did drop a bit on the ex-bonus number there, but it was expected to, in other calendars, to come down to 5.8%. So it would have beaten expectations on that. So still sticky wages. This is something the Bank of England wants to see come down. So the BOE facing a potentially weaker jobs market, but still sticky inflation pressures, puts them in a bit of a pickle when deciding what to do with rates. The needle hasn't really changed on rate expectations in terms of whether we're pricing cuts or not. I think the pricing moved about 5 pips for pricing of cuts, so nothing really of note there. The jobs market is still doing pretty good, even with an unemployment rate at 4.2%, still quite low, a bit like in the US, that even if you get a jump in unemployment, it's still at very low levels. So there's more to be taken from the higher for longer stance to do with this data than the let's get ready to cut. But this is only part one of several items of data we've got this week. CPI tomorrow will be even bigger. And then we round it off with retail sales on Friday. So we'll get a good broad look at it. But as far as this data point goes, it's more inflationary pressure than anything else to take from that. We've got BOE Deputy Governor or incoming Deputy Governor Lombardelli speaking in Parliament. Nothing really of note. Says the decline in inflation is likely to be bumpy. Kay, what did you make of anything we got from that lot? UK, Eurozone, China?
Mixed bag on the UK data. I know those inflationary pressures on the earnings, but I think February is also bonus month, right? In that respect, I'm going to say that I'm not completely overwhelmed with those numbers. We had a bit of a blip lower in the cable. The algos took hold of the 4.2%, I guess, unemployment rate. And then we just rebounded and done the whole thing. Cable flat, bang in the middle, and let's start all over again. I don't make too much out of these. I think tomorrow's data will be probably more important. We do have Bailey out later today as well, if I'm correct. And again tomorrow, if I'm correct, or a bit later in the week. Yep, tomorrow is slated as well. He can undo any good picture for the sterling, as we know. I'm very mixed on those data. I haven't really done anything at all in the sterling because I couldn't really find anything to do. Perhaps a little low to sell it. Perhaps a little, I don't know, dangerous to go and buy dollars. Now we've done already such a move, and with Powell ahead, but yeah, I think Powell is going to be the big one. What I want to come back on just for a minute is the we're starting the IMF meetings and tomorrow the G20, right? And I saw in the news that the UEDA is going over there, actually from today until the 21st. And I suspect, but I haven't seen any confirmation, that Suzuki will be at the G20 finance ministers meetings. There's a bit of a thought. Does that mean that there is no intervention until they return from those meetings? Because I couldn't imagine UEDA being over in the States, having a party with Georgieva and his G20 buddies, and Suzuki, and them still intervening. So I've got the impression we may even print a higher dollar yen just over the next few days until they are back from those G20 meetings. I may be reading a bit too much in it, but it's a thought that I had yesterday already, and then this morning seeing the UEDA line. It's a bit bizarre.
Yeah, I mean, they must send someone. They can't have a G20 meeting and not send over someone from the finance ministry. It's
No, I think Suzuki will be going. I haven't seen the confirmation, but the funny thing is Ueda and Suzuki being out of the country, but we can imagine that they won't intervene, right? If you decide to intervene, those two main persons implicated in intervention should be on the desk, right?
Hey, this day and age, mate, internet trading, they can do what they like where they like. They could be on the moon and intervene.
Well, you're still talking about Japan.
Yeah, I mean, we've said it's a potential risk period. Do they? Don't they? Can they? Can't they? Are they going to, tip the nod? But I don't think they need to meet face to face to do that. They'll be on the phone or whatever, as we know they all speak. But yeah, it's no doubt will get the market thinking along the same lines as well. But we shall wait and see. I've got a couple of headlines that might be an influence in their decision making, which I'll touch on shortly. But moving on, let's have a look at what happened in the US data yesterday, because we got retail sales, which pretty much blew the bloody doors off. Big, strong numbers coming out from there. Yes, I know, and one of Steve's arguments is that this is not adjusted for inflation, so it just could be people paying more for the same amount, but still the numbers are the numbers. They all came in green, so that helped give the dollar another leg or another boost, should we say, another shot in the arm. What was a bit sucky was Empire State Manufacturing, which has been no real weather vane of late. It's really been all over the place, this one, but it's still a negative number, missing expectations, although an improvement over last month. National Housing Association Market Index or Association Home Builders Index came in unchanged at 51, so no real wobbles there. We've had obviously some Fed heads out. Now, Williams, I'm a bit concerned about. We're in a strange situation, as we know, with what's going on in US growth and inflation and rates and whatever. He says consumer spending is driven by strong fundamentals. He's getting more optimistic about potential growth and thinks the economy will continue to grow at a solid rate. Now, those comments are at odds with what they want to do with rates, which is cut them. He says my own view is that rate cuts will likely start this year. It's a very strange situation to be cutting rates into economic strength. It's almost off the playbook, because usually when you get economic strength, you look to use rates to stop things getting too hot, not to stop it, but stop things getting too hot, too frothy. But in this case, they still seemingly want to cut while the economy is doing so well. Now, yes, the rates at the level they are may do damage in the future, and we know they want to get them down to neutral, but still, those types of comments just don't fit together in my esteemed view. Others may have other views. Fed's Daily says inflation bumps along the way aren't particularly surprising. Doesn't want to end up with too strong or too weak a policy response. The worst thing to do is act urgently when urgency isn't necessary. So taking a cautionary line there. It says inflation is above target and we need to be confident it's on its way to target before we can react. We can't just look at published information, as that's backward looking. Well, that's all we get, really, the backward looking data. It says there's no urgency to cut rates. Again, also like Williams, the economy is growing at a solid clip. Labour market is still strong. Our progress on inflation has been significant, but we're still not there yet. And on the old changing the inflation goalposts, there is no way I would support changing the 2% inflation goal when we haven't achieved it. What do you make of these Fed comments, Kay? Because it is a bit strange them talking so bullishly about the economy, then still pumping rate cuts.
Yeah, no, and it's I'm still, well, okay. My base case is still that they are not going to hike. That is a one thing. But it seems like we are going to they're pushing out possibly the boat for longer. It's one day or another we may have to prove the market right that they are going to price out June. Um, yeah, I mean they are seeing the data. They are seeing the same data as we are seeing. Again, I think the main man is probably going to be Powell. Some of the prior comments of some Fed members have been too hawkish and screwed back a little, but yeah, it's if you take the comments separately, one from another, you may think, okay, I mean, there's absolutely no reason to cut, and which is true. If you look at the numbers, there's no reason to cut, but they may find things in the outlook, perhaps for housing, perhaps for mortgage rates staying too high for too long, perhaps a reason for just do something to just keep the party going, and that may be the reason why they will still cut while in a very good economic situation right now. But it's starting where we were like very convinced that they would start to cut somewhere around June. We need to now think about the possibilities of them not cutting in June yet, right?
Yeah, yeah, exactly.
And
100%.
but again, get all of a sudden a negative slew of data next month or so, and then the pendulum will swing very hard again. And I suspect that then, because they are no different than any of us apparently, the way they change their speech, it's possibly that the same people then are going to say like, well, yeah, we are ready to cut now, and we take back all the hawkish talks. I think. Yeah, it's as I was saying, it's messy Q2. Now they have to wear on the hawkish side, but it can turn around again in May, I think the messy Q2 is just continuing.
Yeah, yeah. And as we like to say, you can't marry a trade or a bias for too long because, as you just said, one piece of data, a couple of pieces of data, or one phrase from Powell, and it all turns around once again. So, yeah, that's what the landscape we're in at the moment. But it's good for volatility, which is up at the moment.
Mhm.
Dollar yen is up near 10%, 9.77. Euro dollar up near 7%, cable over 7%. So that's good for intraday moves anyway. Just means there's a bit of life in markets if we do get bits and pieces moving. We've just had a few more comments out from Lombardelli, who's setting herself up in the dovish camp by saying loosening of rates is the direction of travel. Won't say when she will vote for cuts. So just, as I say, taking a seat at the BOE. So views are going to be important moving forward. Right, moving forward. Tesla is laying off more than 10% of its workforce. Some 15,000 jobs are to be going there, according to a memo from his nibs Musk. So that's going to feature into the next Challenger layoffs report, and still showing that the auto industry is looking a bit wobbly at the moment. A few more bank calls to bring you. I love these. SocGen said that if the FOMC doesn't cut rates at all this year, euro dollar is likely to trade back below 105 and cable likely to test 120. Morgan Stanley have taken the hatchet to their ECB expectations. They now see them cutting 75 pips this year versus 100 pips in their previous forecast. Deutsche Bank gone further. They also see 75 pips this year, but their prior forecast was cutting 125 pips. So none of them getting it right as per usual. We've obviously still got this geopolitical stuff going on, Israel and Iran, and there's been a lot of back and forth on both sides of the. I don't know, would describe it, the conciliatory and attacking side of things. 1 minute Iran saying it will retaliate to Israel, and then it says, well, we don't want to escalate things, and Israel saying pretty much the same thing. We need to retaliate. We're going to hit them hard, but we don't want to stoke a wider conflict, blah, blah, blah. So there's a lot of talk going on. There was one comment that came out last night from an Iranian official saying that the country is ready to use a weapon we have never used before if Israel launches a retaliatory attack. Israel are still apparently imminently going to retaliate to the retaliation. We just need to see what that retaliation is, whether it's something that is more intended to be a bit for show than actually anything damaging, just so they can say that they had a response. But it could be something more. That risk cloud is still hanging over markets at the moment. It's only going to take one headline, one action to spark some big risk off moves. Or conversely, if it turns out to be nothing really damaging, then the market might again see a bounce in risk. But we've still got this thing going on. Now, a comment I did want to bring you. Bloomberg had a couple of pieces out, and it's important for a couple of reasons. Firstly, I had a piece out saying that dollar strengthening bets are getting pricier in the option markets, i.e. the prices of call options for dollar strengthening is getting more expensive, meaning that people are looking that side when they're looking at options and hedging and that sort of thing. Now, that's important, obviously, for its connotations for the dollar, but that's also important for the Bank of Japan, because obviously looking at dollar yen, or the Ministry of Finance, because that adds more potential speculative nature to trading something like dollar yen, particularly in the options, and speculation is something they look at very much. It's very important. Bloomberg were also out with another piece specifically talking about dollar yen, and it had JP Morgan and Bank of America seeing the prospect of 160 in dollar yen. MUFG, Mitsubishi Financial Group, they see dollar yen perhaps falling to 160.20. Very specific, that number, and I'll show you why in a minute, without intervention. But they see the risk of intervention coming if 155 breaks. T. Rowe Price sees a risk of 170 happening. So add those two together, and a lot of banks are seeing higher yen pairs or higher dollar yen, which again won't be good news for those in Japan. Add it to that option thing, it's all just creating some conditions that they might be a bit concerned about over there in Japan. Now, before I bring Cayman in, why is 160.20 important in dollar yen? I actually brought this up on the trade-off I recorded this week with Michael Brown, and it's this area here that I've had on my chart. It's the only, as you can see, it's the only horizontal line apart from 152 I've had on here. This is a series of highs, weekly highs, going back to the 90s. It's just an area where there's been a bit of traffic. As you can see, we had a little bit of traffic there, some traffic through there, and as I say, it's a series of weekly highs, and I'm trying to zoom it in for you, just along there. So several weeks we were knocking around that up towards those 159s, high 160s. So to have one of the banks highlight that number specifically, 160.20, shows you that they've got their eyes on it too. So if it's a level they're looking at, it's a level we need to look at as well. Kay, what are your thoughts on all that? Would this ramping up in option bets have the MOF a little bit worried about speculation?
Yeah, that level is exactly the one that I've been showing already a couple of times in the room as well. It's and that's also based on the fact. Remember, like even the end of last year, we're talking about the yen, and and the first phase, I think, of this year as well. I said I still think the yen is going to weaken this year. Yeah, that 160 has a very big target on its back. Now on the option side, I've just been looking at it. The dollar bid is very much across the board when I look at the options. But actually, in dollar yen, it's still pretty much okay because dollar yen people always buy protection against interventions, and you have the big forwards side as well. So the smile, we call it the smile when you look at the curve of the option prices versus strikes. That's called a smile. If you bring it, yeah, the one on the low there, that's called the smile. And we see that the vols are higher, but we still see that the downside is not more expensive because of the swaps, yeah, because of the forwards are very much against the low end of the dollar yen, which is normal because if you buy dollar yen and you keep it for a month, you're going to get paid for it. So, but if you're short dollar yen, you need to pay up. So that means that puts are always going to be more expensive unless the dollar rates collapse to the level of the yen rates, which is basically not on the cards today. But yeah, they have ticked up, and especially in the longer end. If you move over to the 6 and the 12 months, there you see that people are very much willing to pay up a lot more for the longer term, for the longer medium term. That means that, and it's been so for a while. That means that like speculators it's actually the way that I mostly trade my options as well. For the longer end, but the speculators on the longer term, they do think that there's still a very high possibility that the Bank of Japan is going to be very slow. They also see the US data out right now, and the long end smoothens out any intervention risk. Okay, so that's why the long end is probably showing the more the dollar demand much more than the short end may do right now. But yeah, on other pairs, it's actually yeah, screaming for the downside. If you look euro dollar cable. And on the shorter end, you've got to go back on the shorter end, like the 1 month. And for instance, you see the puts are getting more expensive compared to the calls vis-a-vis a week ago or a month ago. So that reflects the option bias. The thing about well, okay, if I start to talk about options, I can go on for hours. But in short, the thing about this is that people also want to pay away premium, all right, but they prefer the pay away some premium, perhaps compared to cash positions. Although we have seen cash positions rising as well, so there's a bit of a the need or the willingness to spread the risks a little bit, because you can always have something going against you on a cash position, but on an option position you basically just risk your premium, right? So but it's clear that the market now, with the combination of the data, the market feels that the dollar has more upside. If you go to stuff like cable, and I think Aussie as well, it's pretty hard for the downside if you look at the Aussie, and which is interesting because if you compare it to the yen, where the differentials are much bigger than for Aussie or euro or sterling, for instance, it's actually more on the euro, the sterling, and the Aussie that it reflects those dollar buyers right now in the shorter end of the curve. That is, so it's widespread. Let's put it that way. It's not only speculative against the yen.
Oh yeah, no, never in doubt. And what do you make of these all these banks ratcheting up their calls for where the yen's going? Is that something that will feature in the minds of the MOF? Are they looking at what everyone's expecting, and would that then
Well,
them think?
well, they know, huh? They know. Okay, just in short, I mean the agent banks and the Japanese mega banks, the big 3 or 4 Japanese banks, they are in constant contact with the MOF. I know it when I used to work for an agent bank, not a non-Japanese bank, but an Asian bank, and we were in constant contact with the MOF. They know. I'm not going to say to the dollar, but to use this figure of speech, they know to the dollar what's happening in the market. Um, so they know about all the expectations. They get all the research as well. They get those pieces, the same pieces as we get, or we get sometimes to see, and they get even more. So they have all this research. They know what's happening, and that's why they always say like, oh yeah, we think there is speculation because they see what's happening in the options market. They get information from everywhere. They are not in the left in the dark. They know Bank of Japan, MOF. They know exactly what's happening in the market. So yes, they will know that. And again, why I am nervous about, or a little more nervous, or why I covered all my call right now, is that because not only the speculation thing is going on, but the fact that they were surprised after with the market reaction after the Bank of Japan, and that adds this layer of a bit of uncertainty, around possible interventions. Now, my long-term view hasn't changed. For as long as the Bank of Japan doesn't start to surprise us and start to hike rates just because of the level of the yen. It is probably going to continue because the major issues in the Japanese market are still there. They are still combating an aging population. Yes, they are trying to do something, but it's like drip feeding the migration, the immigration. It still takes years and years before you get to be a permanent resident over there. It still takes ages to get your paperwork in order. And yeah, let's face it, the economic data are like jumping around, but the local economy, the Japanese in-house economy, is still not like on a roll. And then you got the additional thing, and we all talk about Watanabe and Son since the pandemic, and the investments that they do, but we still have to imagine that despite those higher wages, um, the Japanese is a saver, right? They save a lot. They save a lot of money. So a lot of that money that they will get from higher wages is not going to go directly into the economy, but it's probably going to go into savings account. Now they get a little more than what they have not been getting for many years. So I think in the underlying situation in Japan, to me, maybe evolving slowly, but it's far from changing yet. And so my long-term view on the yen is it's still, as I said, unless we get like big surprises, is that still, yeah, we are going to see a weaker yen.
Yeah, and that's part of Kishida's plan, his virtuous economic cycle to get those yens out of bank
Yeah.
accounts and into the economy. And yeah, he may succeed. He's having a go. You got to give him that, but it's going to be a while before we see whether that happens. And I
Yeah.
think, yeah, Gav's right. The MOF are probably listening here too, mate. We know we've
And
got guys in here.
yeah, and if we look back at Abe, this was actually Kishida is sort of continuing what Abe has started, because that was his big plan, was to revive inflation, but at the same time putting in like massive amounts of stimulus, whatever, to create this virtual cycle. But we are 12 years later,
Yeah.
and they're still working on it. So that knowing from experience what goes on in Japanese markets and with Japanese investors, yes, we can see bouts of yen strengths. Yes, of course, but um, eh, in the really long term, I still think there's an issue for the Japanese yen to remain stronger for longer. You know.
Yeah, exactly. It's still trying to turn an old tanker with a spoon and getting the Japanese to change their mindset. But anyway, like you say, we can talk talk about this for hours. Just looking at dollar yen at the moment, it's looking like it wants to have another creep higher, take out that high from a couple of hours ago. So it's non-stop from this one. And the higher it goes, the greater that intervention risk grows as well. But we'll obviously have to look at the speed of these moves too. That's what they'll take into consideration. Right, just looking at a couple of other pairs. I was going to look at cable brand, so hang on to your knickers. I was already going there. Hello, it's our old magic mate again, the 124.50 level that's playing ball again. This has been an age-old level that we've watched time and time again. As you can see, just going back, it's one of these sort of pivot levels where we sort of end up getting stuck around it. And we don't know whether we're going above it, below it, above it, below it. And as you can see, it's having the same effect today. When you look at it on a bit of a shorter timeline, we don't know whether we want to stay above, stay below, stay above, stay below. So I think this one you've got to look at if we start to build on it, like we did try to here, then it needs to do a bit more. It gives you a little bit of a base. But as soon as we break under, it's holding as resistance again. And then, we're back into indecision mode. So this is something you can probably, it's bang in the middle sort of thing between 124 and 125. So if we're below this line, it's got to take out 124. If it doesn't take out 124, chances are we're going to come back. Same on the top side. We had a move above, can't take out 125. Back we come and we try it all again. So your real range is probably 124, 125. And as I say, this is a bit of a pivot level in the middle. So it might be good for some of you scalpers, but for determining the next direction, it has to be above 125 or below 124 to continue on its merry way, one way or another. Yeah, and that's exactly it, Brand. Just see what the level does. If you're a short-term trader and you start to see a couple of holds above here on a 15-minute chart, then you might want to try along and see if you get a run to 125. Conversely, if we're holding below, then you could always try and scout the short side down to 124 or the low 124s and see what it wants to do thereafter. But on the wider basis, that's your range for now, and you need to break of either side for something more to happen from it. Euro sterling, staying on the quid theme, we're knocking around this 85.35. It's not, I wouldn't call it as strong a level as the 124.50, but it's just another one of these levels we tend to find ourselves glued to when we can't get through 50 or down through 20s. It's a bit of a similar story here. Still undecided about whether we're going to get another 85 test or not. Kay mentioned to Ali yesterday, if you want to try knocking around the 85 to 2025 area, you can do so. And look, we've had a couple of goes down in that area as well. And the bounce is limited up towards this 50 area as well. So again, if you're a scalper, don't mind trying to grab 10, 15 pips here or there. At the moment, this is producing the goods for you. As for the rest, euro, dollar, not doing an awful lot. It's still looking a bit weak. We've had a test down towards the 106 area, just getting down quite low to that. So a bit of a big figure play going on here. But the bounces for now looking pretty weak, pretty limited. So it doesn't look like this trend wants to change around just yet. Again, Powell could be a bit of a maker or breaker for this one down at the 106. If we get under 106, the level after that, it's the big old 105 zone. And that's really what it's all about down here, however it messes around here. Well, that's the zone for me anyway. 104, 90s, 105s, that's it. That's the big decider. If we get under there, if we break through there, then all those parity calls are going to be piping up again as they've already started. One trade that's knocked me out with all this stuff going on with the dollar was my dollar MEX shorts. I've given a bit back, so I've ended up down a bit overall, but not as much as I started off, because I was taking some good profits on these moves and a bit yesterday, but it's had a real little poke up, knocked out the rest of my shorts. I'm going to be sitting on my hands, I think, a bit for this one at the moment. I don't know. I might look at this 106.99, 107 area, which is the big zone above, should we get up there. Kay, is this one's looking a bit more of a risk play at the moment than anything else?
There's two things going on, as I said this morning in the room. It's risk and I think positioning. We have seen so many articles that speculators, investors have been adding constantly to the MEX positions, and I think yesterday we had that little move lower in both dollar and euro MEX or other MEX crosses, and I think some of those species decided it's time to take some off the table, because first of all, we don't know yet the reaction of Israel versus Iran. It's perhaps not completely, perhaps not completely done with that Hormuz Strait thing either. And then those positioning, and I think that's exactly what we are seeing now. Look at it on a global, look at it on a longer term picture. Nothing changed so far. The medium to long term long Mexican peso traders are still feeling very comfortable. We have seen such a big rally in the Mexican peso that they are still quite comfortable. If you look at that, even let's say from the mid of last year, we are still like about a fair bit of percentages stronger, and I don't think that the medium term or longer term traders are very nervous right now. But in the shorter term, I would not exclude a bit more of this going on. And on the other hand, also, let's face Powell, right? If he has to come out very hawkish today because of the data coming out of late, we may see still the dollar being underpinned globally, and perhaps this time the dollar MEX, because I think that must be the biggest vehicle where people are invested in. The dollar MEX may perhaps have a look back at the 17 zone. Why not? It's all within the possibilities, even without changing the overall longer term picture. And if I'm not mistaken, let me just have a look. No, we still have to wait a couple of weeks for the next Banxico meeting. So from their side, it's not going to come. Yeah. So retracements, corrections, they're part and parcel of a market, right?
Yeah, exactly. Yeah, I might, if nothing really comes of, well, hopefully nothing really comes of Israel, I think I might look to get back into shorts.
Yeah,
but like you say, need to ride the power risk first as well. If he comes out saying cuts are still appropriate, then I might have to hit the button on more shorts on this. But yeah,
no, I'm in the same boat, mate. I scaled back a lot of what I had, and it wasn't already big anymore, because the lower we went, the less I actually did, and I'm really skeleton position right now. Not going to hurt anything whichever way it goes. But yeah, I'm looking at the same thing. Risk and power, and then we'll decide. Sometimes it's good to take a bit of a step back and let the market do its thing for a while.
Yeah, exactly. Right, one other one I want to look at quickly before I hand it over to the K-Meister is stocks, because we have hit the support level, and we're finding a bit of traffic down here. This trend has been going on now since we made those tops. Oh, come on, zoom in. There we go. So this was one of my support zones. You know, as I say, we was watching this sort of mini channel that had formed. We've broken that. We've now hit the support point, one of my big support areas, 50, 40, 50. So that's a pretty big one. I've added to my longs here, but I'm treating it as a short-term play, and actually got my stops on the rest of my trade from 48s just below 50.30. So if we do break here, that will signal that maybe something more is going on in terms of seeing stocks coming off. But for the moment, the support level, it's something new. It only started here in February, and it only confirmed a few times through to March. So it's not a historical 10-year level or anything like that. It's just a few months old level. But that's where the market is parking up for now. If we break that, we're probably going to be running to 5,000 not too long after, which is, again, more of a, it has been a bit of a level, but it's also a bit more of a psychological level, as you can see there. We've got some candle tops and bottoms coming in against it. So still, the trend doesn't change until we start knocking out some of these fibs. Now, I know a lot of people have got fibs maybe at all these lows. There's several places you can put fibs all along here. But for me, that just makes it a bit messy. So I'm just going to stick to the clearest high-low that we've got here for my trend definition or defining, if you like. And so 48.30 is still on the wider basis, the 38.2 fib, where this trend may start to look like it's really in trouble. This, at the moment, nothing. It's still all short-term stuff. So I'm not too concerned at the moment, but I will tighten my stops up as I have. Kay, do you want to take it over, mate?
Yeah, quickie. Not going to show too much looking at the clock, but just a couple of things. Yeah. The dollar yen, that's your 155 right there. Just looking at the text, is the 127 extension of the move that we had over year end. So that's your 155. That's going to be your next nice big round big figure. Well, 155.08, but what's 8 pips among friends when we just have done 700 or so, 800 even. So that is your level there. It only would start the overall picture will only start to change. Well, 153.60 is a small one there, but I think 152.5 is going to be a level that we need to watch, and the prior highs where we kept on knocking our head against for a while, 152. If it comes in a natural way, then I think something may kind of change, and there is a possibility to go and have a look at 150 or even below. If it all comes through interventions, then I think when the dust settles, I think 150 is going to be your marker. But looking at where we are and looking at the size of the moves that MOF succeeded to put in, if you would assume that they start to come in from here, 500-600 points, which is going to lead us to 150 or just below, may already be enough. And again, without being wanting to be overly bearish on the yen, if the dust settles and we are above 150, I would still think it's extremely bullish for the dollar yen once they would have done interventions. All, of course, under the condition that they intervene at all, which is still not the case. And perhaps the market is going to try and test them while the IMF and the G20 meetings are going on. Okay, and today is Canadian CPI day. And we stopped up to now. We stopped on the 88.6 of the year-end decline of the dollar Canada. So that's going to be the level that I'm going to. Well, actually, I won't be around this afternoon. Oh, shite! I can't even trade it. I will be gone. But anyway, that's a level that's marked on my radar. And the downside, I think it starts around 137.40, but I think then the bigger zone is going to be right around the 137 right now. If we get an overshoot and dollar Canada can break back sub 137, the party may be over. But also don't forget that McClem is talking at the same time. That Powell is talking later on today. So CPI may give us one move, and then McClem may either undo it or push the move, okay? And I would say the more explosive move could still be to the top side because we've had that sluggish labor report, and if the CPI comes out this afternoon already a little bit weaker, it's going to be tough for McClem to support the Canadian dollar for too much. So these are the levels to watch. I suspect that if we get back into this zone here without too much of surprises on the CPI, we should find buyers in the dollar CAD. That's how I look at things. And quick look at what we are doing here. I told you about this 2026 zone. This is exactly where we held the setback on, and we are ramping higher again. Again, more than anything else, it's still trading geopolitics. So I would still view the Middle East situation potentially under the surface, Russia, Ukraine, a bit as drivers of this more than the dollar, unless we get some surprisingly weak dollar stuff out to push through. But I would still say that what we saw here could be a bit of a high here, all right? If we start to move back below 23.20, I think there's a fair possibility we revisit mid-22s, so around 22.50, okay? That's how it looks in gold. And silver had this spike again in sympathy with oil as well, but we stopped around $29, stopped around roughly around this bit of a channel trend line here, and we're shying away from it. We're seeing the rest of the commodity sphere also coming back a little bit. This is going to trade with both geopols and the rest of the commodity environment, okay? For the time being, I'm not really interested unless we get back for a starter around 27.5, even $27 before 25s. But tiny leftover, but patiently waiting for developments here. And that's about it, guys. I think euro dollar 105.95, 106 the figure, 106.15. Interesting zone for when Powell will talk. Cable similar. I still have the impression that even though cable comes off with the rest of the dollars, that sterling is still holding all right. I think anything negative from Powell, and we could see a bit of a move back up above this 124.60 to move back closer towards 25 perhaps. But of course, if Powell remains hawkish, we could get a move back down below this 124.15.20, and then start to move into the mid 123s. Neutral on the sterling right now, but I still haven't given up on sterling doing better than other stuff on my global view. And with that, back over to you, Ryan.
Thank you very much, mate. Well, just before we go, just want to highlight again, in case you haven't seen it, our new mentorship program. If you need any sort of help with your trading, you can check out our coaches here, including myself and the good K-Man. So have a look at that. We're here to help you if you need any help at all with your trading. This is a bit of an investment in yourself that you can make just to get that one-on-one interaction with us, take us in a private situation there. So check that out if you haven't, see what coaches have to offer there, and if it can help you out, then great. Other than that, thank you very much for coming to the show today. Have a great day, everyone. Watch out for power later. It could be a biggie. And thank you, K-Man, as always, for your valued insight. We shall see you all tomorrow.